Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
I kick out?
Chicken out.
Oh, isn't that nice? Chicken out. I've never heard that.
Wall Street has a new acronym, TACO, short for Trump always chickens out. It's not a joke from late-night TV. It's a market term now used to describe President Trump's unpredictable tariff strategy. From 145% duties on China to a 50% threat against Europe. Many of these tariffs start strong, and then quietly soften. But behind the headlines and the memes lies a bigger question. What's the real economic cost of this volatility? And why does the taco trade matter to global business? The term taco first surfaced in financial newsletters in early May 2025 and quickly spread across trading floors and media outlets. It refers to a pattern. President Trump often makes aggressive tariff threats, then pulls back or delays them after markets react. Let's look at a few examples. In April 2025, Trump reimposed a 145% tariff on Chinese goods, citing national security and fentanyl concerns. By mid-May, after intense market backlash and a temporary deal with China, the tariff was scaled back to 30% for 90 days. Then came Europe. Trump warned of a 50% tariff on EU imports starting June 1st. But following a call with European Commission President Ursula von der Leyen, that deadline was extended to July 9th. This cycle of escalation and retreat is what analysts now call taco. According to Bloomberg, the term was coined by Robert Armstrong of the Financial Times and was later picked up by CNBC, MSNBC, and the Wall Street Journal. On top of the policy swings, court decisions have added another layer of instability. In late May, the U.S. Court of International Trade ruled several of Trump's tariffs unconstitutional, especially the 10% blanket rate and the 20% fentanyl-linked duty. However, a federal appeals court quickly put a hold on that ruling, allowing the tariffs to stay in place temporarily. The result? Confusion for businesses. Nick Vyas, a supply chain expert at USC, explained, "All it does is shock the system with uncertainty. Many businesses are struggling to figure out their overseas supply chains. At the Port of Long Beach, canceled shipping routes remain on hold. Officials say they won't resume until there's clarity on how tariffs will be enforced. And that's the problem. Uncertainty is now baked into trade."
The greatest nemesis of a stable and growing economy is uncertainty. And this right now, the American employer or the small business owner or the importer or exporter is trapped between a decision and a White House.
So what does the taco trade mean for markets? When Trump backs down from a tariff, markets often rally, viewing it as a sign of moderation. When he escalates again, stocks drop, exporters panic, and central banks hesitate. According to Capital Economics, the average U.S. tariff rate has fluctuated between 6.5% and 15% over the past year, depending on pending court decisions and executive actions. Investors have learned to trade the tariff noise. But for businesses like Nike, Walmart, and Ford, the impact is very real. Nike, for instance, sources a majority of its products from Vietnam and China, both under heightened tariffs. Even as Trump threatens Apple and Samsung over iPhone production, companies like Nike are quietly adjusting prices or shrinking margins.
And to tell you the truth, Nicole, I'm a little horrified by it because you have to remember, Trump chickening out is a good thing.
When asked about the taco nickname, Trump didn't hold back. "I've never heard that. It's called negotiation," he told reporters. He defended his strategy as part of the art of the deal. Set a high number, then work down to get leverage. Trump insists these moves are working. He points to $14 trillion in new investment commitments, though those numbers are still under review. In his view, just threatening tariffs has pushed countries to the negotiating table. But critics, including market analysts, warn that while this strategy may score short-term wins, it's disrupting long-term planning for global businesses. So, is the taco trade just a clever Wall Street meme or a real economic signal? Either way, the stakes are high. With the July 9th deadline looming on EU tariffs, businesses, consumers, and investors are holding their breath. What comes next? A 50% tariff? Another walkback? Or just more uncertainty? One thing's clear. In today's global economy, the cost of unpredictability may be harder to measure than the tariff itself. Taco might be a Wall Street meme today, but on July 9th, it could shape your wallet.
A 50% tax on all imports from the European Union. Trump is saying he was upset by the lack of progress in trade talks with the EU.
President Trump just threatened to hit the European Union with a 50% tariff on all imported goods. The reason? He says negotiations are going nowhere. But here's the real question. Would this bold move actually help the U.S. economy? Or just drive up costs for everyone? Let's break it down.
I'm not looking for a deal. I mean, we've set the deal. It's at 50%. But again, there is no tariff if they build their plant here.
Trump's latest comments came after a meeting with European Commission President Ursula von der Leyen failed to deliver immediate progress on trade. Posting on Truth Social, Trump claimed the EU was formed to take advantage of the United States, citing what he called unfair VAT systems, regulatory barriers, and trade surpluses. Currently, the European Union enjoys a goods trade surplus of around $210 billion with the U.S., based on 2024 data from the U.S. Trade Representative, USTR. However, if you factor in services, where the U.S. leads in finance, tech, and consulting, the overall imbalance shrinks to less than half that number. Still, nuance isn't driving this policy. Trump's stance is clear. If EU products aren't made in America, they'll face a 50% tariff, starting July 9th, following a temporary delay agreed to after a call with von der Leyen.
U.S. and European stocks tumbled in response to his remarks. In a statement from the Oval Office, Trump renewed his pressure on European companies to move production to the U.S.
According to former White House economist Bharat Ramamurthy, CNN, May 2025, this kind of across-the-board tariff would likely hurt American manufacturers first, not last. Why? Because the top EU exports to the US aren't cheap wine and cheese. They're intermediate goods. Think German machine tools, French industrial chemicals, and precision parts used by US automakers and aerospace companies. These are inputs, not final products. And when you tax them at 50%, you raise the cost of building things in America. Economists at the Peterson Institute for International Economics estimate that a tariff of this size could raise domestic production costs by 12 to 18% in sectors like auto manufacturing and industrial machinery. That kind of shock could force U.S. producers to either eat the costs, cut corners, or raise prices, all of which hurt their global competitiveness. Meanwhile, consumers wouldn't be spared either. A May 2025 report from DW News confirmed that EU companies are front-loading shipments to the U.S., racing to get products through customs before the July 9th deadline. This is already straining ports, warehouses, and trucking networks, pushing logistics costs higher. Expect sticker shock. A BMW X5 assembled in Germany could jump from $65,000 to over $80,000. Kitchen appliances from brands like Bosch or Miele may see price hikes of 25 to 30%. Even certain medications and medical devices imported from Europe could face disruptions or price volatility. And remember, if EU retaliates, a real possibility, US exports like Boeing jets, Levi's jeans, or Harley-Davidson bikes could be next on the list. Trump insists this isn't about punishment. It's a negotiating tactic. His message to Europe: build your plants here, create American jobs, or pay the price. It's textbook leverage, but it's also increasingly risky. As EU Trade Commissioner Maroš Šefčovič said in response, "What we need is mutual respect, not tariffs." Translation: Europe sees this less as a negotiation and more as coercion. Even conservative economists are sounding the alarm. George Magnus of Oxford University notes that trade deficits aren't solved through tariffs, but through domestic policy reform, investment, savings rates, consumption patterns. Tariffs just rearrange pain, not eliminate imbalance. And ironically, this could undermine the very goal Trump claims to pursue. Many of the EU's exports support US manufacturing. Taxing them doesn't bring jobs back. It may push them further away. Factories that depend on affordable, specialized EU components may be forced to cut back, outsource more, or delay investments entirely. What's more, the uncertainty itself, announcing tariffs on X, changing deadlines week to week, makes long-term planning nearly impossible for global firms. and investors are watching. Wall Street reacted sharply when the tariff threat dropped, with the Dow falling nearly 800 points in a single session. Confidence, once shaken, is hard to rebuild. In the end, Trump's tariff threat to Europe may just be another high-stakes bluff. But whether it's posturing or policy, one thing is clear. The economic costs are real, and the clock to July 9th is ticking fast. If you found this breakdown helpful, consider subscribing for more deep dives like this, and don't forget to hit like to support the channel.